Big news this week. The Federal Reserve is meeting on September 17th, and all eyes are on interest rates. Analysts expect a rate cut of 25 to 50 basis points. What does that mean for you as a homeowner? Well, borrowing money may soon get cheaper, and one of the biggest winners could be the home equity line of credit, or HELOC. In fact, searches for HELOC products have already doubled in the past few weeks, and it's no surprise. With rates potentially heading lower, many homeowners are asking a simple question: should I use a HELOC or a home equity loan to unlock the cash sitting in my house? If you've ever been confused about the difference between the two, stick around, because in this video, we'll break it all down in simple terms, compare the pros and cons, and help you decide which option might make sense for your financial situation. Check out the description below for exclusive link. Let's start with some quick context. Right now, U.S. homeowners are sitting on record levels of tappable equity, over $200,000 on average, according to recent housing data. That's a massive amount of potential borrowing power locked inside real estate. But the big question is, how do you tap into it without selling your home? The answer usually comes down to two options: a home equity line of credit, better known as a HELOC, or a home equity loan. At first glance, they sound almost identical. Both use your home as collateral. Both let you borrow against the equity you've built up. And both typically offer lower rates compared to credit cards or unsecured personal loans. But the way they work, their flexibility, repayment structure, and risks are actually very different. And that's where the confusion often comes in. So let's clear it up step by step. A home equity line of credit works kind of like a giant credit card secured by your home. Instead of giving you one lump sum, your lender approves you for a maximum credit limit. Let's say $100,000. You don't have to take all that money at once. Instead, you can borrow what you need when you need it. Maybe $15,000 for a kitchen upgrade this year, and then another $5,000 for medical expenses 2 years later. This borrowing phase, known as the draw period, usually lasts 5 to 10 years. During this time, you can borrow, repay, and borrow again, just like a revolving credit line. After the draw period ends, you enter the repayment phase, which can last 10 to 20 years. At that point, you can't take out more money, and you'll start repaying both the principal and the interest. Most HELOCs have variable interest rates, which means your payments can fluctuate as the market changes. That's why this week's Fed meeting is so important. If rates go down, HELOCs instantly become more attractive. Check out the description below for exclusive link. Now, let's contrast that with a home equity loan. Instead of a revolving line of credit, this is a one-time lump sum loan, also secured by your home's equity. Here's how it works. The bank gives you a fixed amount of money up front, say $50,000, and you repay it in equal monthly installments over a set period, maybe 10 or 15 years. The big difference? Home equity loans typically have fixed interest rates. That means your payment stays the same each month, no matter what happens with the Fed or market rates. So if predictability and stability are your top priorities, a home equity loan might feel safer than a HELOC. But remember, you only get one lump sum. If you don't use it wisely, or if you need more money later, you'd have to apply for another loan. Check out the description below for exclusive link. Let's do a quick side-by-side comparison to make it crystal clear. Flexibility. HELOCs let you borrow, repay, and borrow again during the draw period. A home equity loan is one lump sum, no revolving credit. Interest rates. HELOCs usually have variable rates, while home equity loans usually have fixed rates. Payments. HELOC payments can change over time, while home equity loan payments are consistent. Best for. HELOCs are great if you need ongoing access to funds, like home renovations spread out over time, or as a financial safety net. Home equity loans are better if you know exactly how much you need up front, like paying for a big medical bill or consolidating debt in one go. Both options use your home as collateral, so in either case, missing payments could put your property at risk. That's why careful planning is key. Check out the description below for exclusive link. So why is this conversation especially important today? Well, if the Fed does cut rates, as expected, HELOCs become more attractive almost overnight. Lower rates mean lower borrowing costs, which makes HELOCs a smart alternative to high-interest credit cards or personal loans. Think of it this way. A credit card may charge you 20% interest or more. A personal loan might sit in the 10% range. But a HELOC, even with variable rates, could come in much lower, sometimes under 8%. And with a potential rate cut, those numbers could shrink further. For homeowners who want to renovate, consolidate debt, or simply have an emergency cushion, now might be one of the best times in years to explore HELOC options. Check out the description below for exclusive link. Renovations. Imagine you want to remodel your kitchen for $30,000. With a HELOC, you could borrow just what you need for the project, and if another project comes up later, say a bathroom upgrade, you can borrow again without starting over. Debt consolidation. Say you have $20,000 in credit card debt at 22% interest. A HELOC at 7% could save you thousands of dollars in interest payments, while giving you flexible repayment terms. Emergency fund. If you're financially comfortable but want peace of mind, a HELOC acts like a backup plan. You don't have to use it, but it's there if an unexpected medical bill, job loss, or other expense comes up. Check out the description below for exclusive link. Of course, no financial product is perfect. A few risks to keep in mind. Variable rates. Your payment could rise if interest rates climb in the future. Collateral risk. Both HELOCs and home equity loans are secured by your home. If you default, foreclosure is a real possibility. Overborrowing. Easy access to cash can be tempting. Borrow only what you can realistically repay. So before jumping in, make sure you've budgeted carefully and compared offers from multiple lenders. Check out the description below for exclusive link. To wrap it up, a HELOC gives you flexibility, like a revolving credit card backed by your home. A home equity loan gives you stability, with fixed payments and a lump sum up front. The right choice depends on your needs, whether you want ongoing access to cash or one predictable loan. Check out the description below for exclusive link. And with the Fed poised to cut rates, both options could become more affordable right now, making this the perfect time for homeowners to educate themselves and explore what's available. If you found this video helpful, make sure to hit the like button and subscribe to Business Snap for more clear, practical financial breakdowns just like this one. And let me know in the comments, would you prefer the flexibility of a HELOC or the stability of a home equity loan? Thanks for watching, and I'll see you in the next one.